I think there's a very good chance we're going to end up in a deal. And so we're giving it 5 days, and then we're going to see where that takes us. And I would say at the end of this period, I think it could very well end up being a very good deal for everybody. As good as if we went all the way and just literally annihilated the place, which if we don't have to do that, that would be a good thing.
President Trump delaying strikes on Iran's energy infrastructure, citing what he called productive talks with Iran. Tehran, though, denies any negotiations have happened. Live from Sydney, I'm Paul Allen, and this is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, the fragile optimism around a potential de-escalation in the Iran war appears to be fading. Oil prices rising again. Asian stocks and US equity futures are pairing earlier gains. Investors also weighing reports that Saudi Arabia and the UAE are taking steps towards joining the war in a potential regional escalation. Coming up, we'll get in-depth analysis on how the conflict might develop and how investors are positioning across asset classes. Plus, Apollo Global Management curbs redemptions from one of its private credit funds, the latest alternative asset manager to grapple with a surge in withdrawal requests. Our top story today, Asian stocks are pairing gains as fragile optimism over a possible Middle East de-escalation start to fade. The Wall Street Journal reporting that Saudi Arabia and the UAE have taken steps towards joining the Iran war. A senior Iranian lawmaker has also reportedly ruled out negotiations with the US. For the latest on the war, Bloomberg Horizon's Middle East and Africa anchor Jumana Baseche joins us now from Dubai. So, Jumana, can you help us understand this? President Trump says he's been talking to Iran, and Iran says that's fake news. So do we have any clarity on what's actually happening?
A really dramatic escalation of events yesterday, and de-escalation, I should say. When we walked in just before the U.S. market opened, President Trump put up that Truth Social post indicating that they had actually been having productive talks. He said good, very productive talks had been taking place with the Iranians, and on the back of that, they decided to push back the timing of the potential strikes on Iranian energy and power plants by 5 days. Again, market observers also note that that would take them to post-market close on Friday. Now, the Iranians, about an hour later, some of these semi-official news sites rejected the claims that there had been direct negotiations, but it's become apparent over the course of the last 12 hours or so from various reporting, including our own reporting, that there had been several indirect mediation attempts, and that has gone through the likes of Turkey, from Egypt, and from Pakistan as well, as what we understand. So indirect discussions taking place. There are reports also suggesting that Pakistan may be later this week looking to host some talks between the two sides. Again, not confirmed yet, but that is the direction of travel that this is moving in. But ultimately, what we've seen here is an attempt out of the U.S. administration to de-intensify the situation and walk back from that perceived red line of going after Iranian civil infrastructure, particularly those power plants. And we also wrote up a report overnight on Bloomberg suggesting that many Gulf states were worried about the potential reprisal that could have come through from Iran on the region's own energy infrastructure and civil infrastructure, including those key desalination sites as well. So what has happened is a momentary de-escalation, but this is not to be confused with the full ending of the war. We're still early days. We don't know if these discussions are actually going to happen, if they're going to yield anything. And at the same time, the joint U.S.-Israeli operations in Iran still continue.
Yeah, it's often the case in this situation, confusing, as you say, conflicting claims as well. And what are we to make in that context of the Wall Street Journal report that Saudi Arabia and the UAE may be looking to join the conflict? That doesn't sound like de-escalation.
Yeah, well, I think you have to piece together everything that the Gulf states have said in the last couple of days. And of note to me, particularly, was the Saudi foreign minister. And this was the night of the Ras Laffan tax in Qatar. He gave a press conference and he warned that Saudi Arabia's patience is running thin. They don't have an unlimited appetite to keep absorbing the blows and keep intercepting the projectiles that are being fired towards them. Yesterday, as well, Saudi Arabia took the unprecedented step of kicking out the attachés, the Iranian attachés, and declaring them person non grata. So reading between the lines there, definitely there's a suggestion that Saudi Arabia's patience is wearing thin. However, if you go back to that Wall Street Journal report, I think you have to draw the distinction between the kingdom allowing the U.S. to use their airbase to launch strikes as opposed to Saudi Arabia getting directly involved militarily. Over here in the UAE, which is where I am, similar language, angry language coming through from top diplomats. You had the likes of Dr. Gargash, he's the main advisor to MBZ, also suggesting that this is no longer a matter of a ceasefire with Iran. This is about regional security. You had Sultan Al-Jaber, this is the CEO of ADNOC, the biggest energy firm, state energy firm here, also give an address yesterday at CERAWeek suggesting that no country in the world should have the right to hold the Strait of Hormuz as hostage. That being said, there's no indication as of yet that the UAE are willingly going to sign up to join the war militarily. However, they have made it very, very clear that an outcome in which Iran still controls the passage of ships through the Strait of Hormuz would be an unacceptable outcome for them. So what you're seeing here is almost a restraining influence on Gulf states, on Trump, to prevent him from going after energy infrastructure out of fear of reprisal in the Gulf states. And at the same time, the feeling that Iran themselves have crossed red lines and that this is going to recalibrate the way many of these Gulf states think about security and cooperation in the future. And many of them are saying that at the end of the day, it's pushing them closer to the U.S. and not further away.
All right, Bloomberg Horizon's Middle East and Africa anchor Jemana Besetche there in Dubai. Well, ship tracking data shows 2 Indian-flagged vessels making their way through the Strait of Hormuz, carrying tens of thousands of tons of LPG. The ships are following the Iranian coastline, a precaution also taken by other vessels approved by Tehran. Oil and shipping reporter Waylon Soon joins us now with more on this. So, Waylon, what are we to make then of the safety in terms of passage through the Strait of Hormuz?
So what we have seen are 2 very large gas carriers that are flagged to India that have passed through the Strait of Hormuz. And in total, there have been 4 so far. And it's noteworthy because when you see the ships sailing through the Strait of Hormuz, they are in fact heading towards Iran and then going around some Iranian islands to exit Hormuz. And I guess in peacetime, you wouldn't see them doing this. Normally, they would actually go nearer to Oman. So this sort of signals to us that Tehran has a stronger control over the Strait of Hormuz. And over the past few days, we have seen traffic really shutting down through the strait, except for a few vessels. So on top of these India-flagged ones, we have Iranian-linked ones, Chinese-linked ones, and of course some of the more darker sanctioned vessels that have gone through. So all in all, we can see vessels that have managed to escape Hormuz. They are the ones that appear to be approved by Tehran to go through.
Yeah, the straits are obviously critical for the flow of energy through the Middle East to the rest of the world. But what are the alternatives here?
Right. So we have about 1/5 of or 1/4 of the world's oil and energy flows going through the strait, and that's now effectively choked off. We have seen Gulf producers shutting in production, but we also see Saudi Arabia and the UAE redirecting some of those crude flows, export flows. So Saudi Arabia to Yanbu, which is on the Red Sea side, and then the UAE to Fujairah, which is on the Gulf of Oman. So they have been able to ramp up production production. But you have to account for all the others that are deeper into the Gulf. They haven't been managed to find good alternative routes to push their crude exports. And when you can't export those barrels, you would have to start cutting down production. And we did a story last week about how Iran has managed to continue exporting its crude at roughly the same levels before the war. So Iran stood to gain from this closure of Hormuz. But what we're talking about is about nearly 10 to 14 or 15 million barrels per day of lost barrels really disappearing from the oil market as a result of this closure. And the longer this drags on, we might see demand destruction happening in oil markets around the world.
That is potential, as well as feedstock for refineries starts to decline, as do run rates. But in terms of the Strait as well, I mean, we have another report of a Japanese-flagged supertanker making its way through the Strait carrying a shipment from Iraq. Can we anticipate that we might see more of this type of thing, and what might it mean for the oil price?
Right. For the supertanker, I think it might be premature to talk about how exactly what were the negotiations, if any. But there's a lot of problems with looking at ship tracking right now as we speak, because the Strait of Hormuz is a highly sensitive area. There's an electronic fog of war over there. We don't know for sure what ships are going in and out, but we do expect to see more and more revelations of what kinds of ships are able to get through. So obviously we know that India has been allowed. Turkey has said that they've been able to get ships through. China hasn't come on record, but obviously Chinese-linked vessels are passing through. Japan and Korea, they have been cautious about this because they are US allies in this respect, but they do also rely heavily on Middle East energy. So as for the back channels that might or may not be happening between Tokyo, Seoul, and Tehran, that's for us to look out for in the days to come.
All right, Bloomberg's Waylon Soon there, thank you. Well, joining us now is Muyu, a senior crude analyst at Kpler. Muyu, thank you so much for joining us today, and I do want to start with the oil price. I mean, we did see it decline following those remarks from President Trump, which, as we've discussed earlier, Iran denies. As we continue to get a conflicting narrative, do you expect to see the oil price continuing to whipsaw?
Yes, I think that will be the case, and we'll see extreme volatility in the market. And I don't think we have seen any meaningful de-escalation in the region. And what President Trump did is just simply kick the can down the road. He simply delayed the attack. He didn't cancel it, and there are still potential attacks or move more troops into the region. So I would say the situation is still very volatile, very fluid. And then in the oil prices, we still see very strong momentum to push the prices up. In fact, we actually see prices got a potential to hit as high as $140 per barrel in 3 to 4 weeks' time. So that's basically a $10 per barrel rise each week if there is no meaningful de-escalation in the conflict.
Well, $140 per barrel if no de-escalation. Now, let's take an optimistic view for a moment, though, and assume that this news is correct, that some talks are underway. But from a crude flow perspective, would a 5-day delay or a window even matter if the Strait effectively remains closed because shipping is potentially too dangerous?
I'm afraid not, because from what we see from the data-wise, there are indeed vessels going through, as your reporter just mentioned, but it's selected and is measured. We still don't know what exactly is the criteria. Iran claims that the vessels linked to its friendly partners can go through, but we don't expect a blanket approvals, for instance, involving all the the Indians or Chinese vessels, because Basically, here we're talking about half of the normal Strait of Hormuz flows. So Iran will control the volumes, and also maybe there will be some sort of mechanism whether you need to pay, or also they will examine where the crudes come from, whether it's from they think it's the enemy countries, from some of the GCC countries, or there's other criteria. So there are a lot of unknown, but what we've seen so far is there are about 40 million barrels of crude oil have been able to exit the Persian Gulf since the war started, and 30 million barrels are actually Iranian. So that means for the non-Iranian crude, which we call it compliant crude, it's only 3% of its normal level, and we don't think this situation will see fundamental change in any time soon. So that means like we don't expect any quick restoration of the safe navigation in the region.
Yeah, well, in the meantime, we've got the US issuing temporary waivers for Russian and Iranian crude as well. Do you feel that that's going to have any effectiveness, though, in terms of cooling prices?
I think the intent is good. Trump wants to cool the oil prices and to increase some supply to meet the imminent demand from the Asian countries. But from the practical point of view, it's very difficult. It's okay for Russian because there are many countries that have been dealing with Russian oil in the recent years, and we have seen the Indian refiners, they snap up a very sizable volume of Russian crude. But regarding the Iranian, things are much more difficult. In fact, after the U.S. issued the waiver, many people in the market, the first question they ask is where they can go if they want to buy Iranian crude. Before the sanctions, Indians, Japan, South Korea, and other countries, they used to buy Iranian crude oil and condensate on their term contract with the national Iranian oil company. But that's like almost a decade ago. So right now, if you want to resume the purchase, probably your old contacts, they're no longer in the companies. And also right now, the market is very fragmented. They've got more suppliers like IRGC or other entities. And then you face very technical issues like payment, what currency you want to pay and what currency they will accept, and via what channel. And then down to the shipments via the clean tanker or dark fleet. So there are many hurdles. And also from the Iran perspective, it's also very risky for them to deal with the new buyers because there's simply no trust between the sellers and buyers. So we do think for the Iranian oil in the near term, the majority will still go into China. Maybe India will take some, but it won't exceed 1 million barrels per day.
Can you tell us a little bit about what you're seeing as well in terms of pressure on Asian refiners, having to cut run rates because they're running out of crude as feedstock?
Indeed. So we are seeing like refiner across the regions, they either bring their maintenance early or they simply just cut their run rates by at least 10 to 20%. At the same time, they are seeking for alternative supplies from the Atlantic Basin or Latin America, but it will take 1 to 2 months before the cargoes arrive. And in the meantime, if the countries, they release the oil reserve, it will help them to buy time. But if not, for instance, like China hasn't announced any SPR releases, then the refineries, they can only rely on themselves to manage their inventories. So in the short term, we will probably see refiners to proceed with deeper cut. And then from the demand perspective, if the situation drag on, we might see some signs of demand destruction starting from next month. Maybe here we're talking about 500,000 barrels per day.
Well, you mentioned at the start of this conversation that your worst case, or there is a case for potentially $140 oil. Well, eventually this conflict will end. Can you see us ever returning to the days of $70 oil, and when might that be?
Maybe next year, because let's say if the war ends right now, it still take about 2-3 months before we see a normal oil flows in the Middle East, because you need to get the tankers out and you need to rebuild the confidence for the ship owner to go into the Persian Gulf, and then tankers need to reposition, and they need evidence to see Iran no longer capable and also willing to attack vessels. And also, nobody knows whether Iran has laid any marine mines or not. So taking all this together, we think probably some sort of normalization of the safe navigation will only happen in the summertime. And then the oil producers, they need weeks or months to resume their oil production, and then countries also need to replenish their inventory. So all this factor will support oil prices in the short term.
All right, Muyu, a senior crude oil analyst at Kpler, thank you so much for joining us. Got some breaking news out of Japan. We're hearing from Nintendo cutting back production of Switch 2 units. This is after disappointing demand, the console trailing the company's expectations during the year-end holiday season, especially in the US. It's planning to make 4 million units of the Switch 2, and that's a third less than the 6 million it had originally planned. This is due to slow consumer demand, but Nintendo's going to wait and see if new titles have enough staying power to merit an output increase, but Nintendo cutting that output by 30% on weak holiday sales. The market at lunch at the moment, so we'll keep an eye out for reaction to that news when the market reopens at the bottom of the hour. Still to come, former US Ambassador to China Nick Burns tells us what he hopes is Beijing's end game in the unfolding war in Iran. This is Bloomberg. Welcome back. You're watching Insight. Former US Ambassador to China Nick Burns says Beijing may have taken a hit on its political credibility with its allies by not intervening diplomatically to support Iran. Burns also told us he thinks Washington is hoping Beijing might push Tehran to resolve the war through diplomacy.
China is very much attached to Iran as a political ally. But I think we've seen in the Chinese reaction over the last 3 or 4 weeks of this war that the Chinese care a lot more about the predictable supply of oil and gas coming out of the Strait of Hormuz, because they're dependent to a very large extent on that flow of energy. And their investments in the United Arab Emirates, in Saudi Arabia, in Qatar, in Bahrain, in Kuwait are far more substantial than what they had coming from Iran. So I think they're of two minds about this. They didn't want to see their political ally bludgeoned the way it has. But it's interesting, David, they haven't really lifted a finger to help politically and diplomatically Iran. They're much more focused on ending the Iranian missile attacks at the Gulf Arab oil and gas refineries. I think they want a quick end to the war itself. And one of the intriguing questions here is there's going to be an end game. There's going to be an attempt to resolve this by diplomacy. Can China play a role in that? And I would say behind the scenes pushing the Iranians to an agreement. That would be, I think, the American hope that they might do that.
Former US Ambassador to China Nick Burns there, speaking to Wall Street Week's David Weston. Coming up, as fragile optimism fades over a possible Middle East de-escalation, more on the underlying risks to global markets with Brandywine Global. Much more ahead. This is Bloomberg. Welcome Welcome back. You're watching Inside. Here's a quick look at where markets stand as mainland Chinese markets head off to lunch. Japan coming back online, and we're seeing a lot of risk on at the moment, although it's been an interesting journey getting here. The Kospi in particular has had a wild ride today. Right now, it's better by 2.3%. It started very strongly about 90 minutes ago, was in negative territory, and now we're up more than 2%. So that tells you about the kind of day we're having as the narrative shifts and we get conflicting information about what President Trump and what Iran is saying about progress towards negotiations. Basically, Trump says it's happening and Iran says it's not. But watch this space. The oil price, meanwhile, has softened somewhat. Brent is down to 103.74. We are keeping an eye on Japan 40-year yields because we do have a 40-year bond auction coming up a little bit later. The Hang Seng better by 1.7%. The CSI 300 by 2/3%. Looking forward to the open in India. We're expecting to see some modest gains there as well. The Nikkei, meanwhile, that's also in positive territory by 0.75%. And one stock that we're keeping an eye on in particular is Nintendo, because we did hear from the company a short time ago. It's cutting back the production of the Switch 2. This is after demand for the console was somewhat disappointing. The company now planning to make 4 million units of the Switch 2 this quarter, and that's less than the 6 million originally planned, although Nintendo is waiting to see if new titles warrant output increases. That stock not trading yet, but before the lunch break was off 2%. Now, we are also keeping an eye on Indian assets. The rupee on Monday fell to a fresh record low. Bond yields, meanwhile, rose to a one-year high. India, of course, not in a great position, having to import most of its energy with a very weak currency as well. We've seen equity markets suffering. A net $594 million worth of Indian equities were sold on March the 20th. That's according to exchange data. Goldman Sachs saying it sees the potential for a shift to a rate rise for India. Right, let's get a little bit more on markets. Get over to MLive Executive Editor Mark Cudmore. So, Mark, it's been a weird day, as I was saying. President Trump saying, hey, we're talking. Iran saying, no, we're not. Does this look like the foundations of a sustainable rally?
No, absolutely not. If anything, I'm probably more bearish, and I say that as someone who's been quite bearish stocks since the conflict started. I think the reason I'm even more bearish today than I was a week ago is that all the material developments we've seen in the past week have been in Iran's favor, and no one has been able to articulate a coherent reason why Iran would seek an off-ramp right now when they've been given more power than they knew they had. They are, in the short term, they've got the upper hand. They've got a chance to finally inflict some damage on the US for the economic means. So, I'm not a geopolitical expert, but no one's been able to give me a logical reason why Iran would want an off-ramp right now, which means I only see escalation. And in fact, the reasons that the bulls are still the majority view. People are very complacent out there, and they keep on talking about, well, Trump wants de-escalation. Of course he does. We always knew that. We always know that Trump tacos. We always know the midterms are coming up. He doesn't want higher energy prices. We always knew there wasn't a clear plan. We've heard so many different versions of whether they want to talk, Iran wants to talk, US wants to talk, but everyone's dead. They are talking, they're not talking, they're winding down, they're threatening. The fact that we're relying on reassurance from Donald Trump on what comes next as a reason to be bullish is extremely alarming to me. So, look, who knows how the conflict plays out? But, just basic game theory implies that you need some incentives from the key protagonists. And I think the only protagonist who is got a massive incentive to wind down the war at the moment is Trump and the US. But there's no really means to. Iran doesn't want it. They want to keep the strait closed to inflict damage on the US economy. It doesn't appear like Israel wants to wind down either. So two of the three key protagonists don't seem to have any reason to wind down just yet. And therefore, the only path I see is that the strait's going to stay closed for a while. Things are going to get worse before they get better. So, yeah, look, despite this being the worst month for global stocks in 3.5 years, I unfortunately still think it's going to get a lot worse over the coming week or so.
Mark, I'd invite you to become even more pessimistic, because one thing we haven't talked about is the role of a player no one's discussed yet, and that's AI, in particular AI analysis of some of these market moves. To what degree is that exaggerating or amplifying some of what we've seen?
Yeah, that's I wrote this macro review column yesterday, just kind of pointing out that I've been confused about the complacency in markets, and what I've realized is that many people, for the first time ever, we might have a markets crisis exacerbated by people handing over critical thinking to AI. And what I mean by that is that there's so much overwhelming information on this Middle East conflict, people aren't knowing how to do it, that they're asking AI for help. What's the precedent? What's the probability? What's the outcome? And the way large language models work is that they kind of weigh up all the writings and precedents in this. And the precedents are Trump always tacos out. Well, we've seen that. The precedents are that Middle East conflicts tends to be a fade in markets. The geopolitical risks blow over. So everything kind of points to the idea that, hey, AI is telling you can try it yourself. If you explore with AI, they seem to lean to the idea that, well, the US administration would have an incentive to back down because of the midterm elections, because Trump has a history of backing down, and because Middle East conflict tends to be a fade, and therefore there will be an opportunity to buy at some point. Obviously, they're very slow to give that conclusion to buy, but if you talk through the scenarios with any of the AIs, they basically reach that outcome. What they're missing is analysis of the key protagonist here is Iran. And Iran currently holds all the cards. A month ago, the world thought that Iran would threaten to close the strait if they were attacked, which is why they weren't attacked for years despite pursuing nuclear weapons. But there was generally a belief in markets that if the US really wanted the strait opened, they could keep the strait opened. And so far that's been proven to not be the case. So Iran has much more power than it probably believed even a month ago. And therefore, if you want to analyze how this plays out, you need to have a coherent off-ramp for Iran. And again, I reiterate, I'm not a geopolitical expert. Maybe there's some solution I've not seen yet, but no one else has seen it either. I've been asking loads of clients out there, and no one's given me what seems to me a logical, reasonable idea for why Iran would off-ramp right now.
Not a geopolitical expert. You can always just ask AI, Mark. That is Bloomberg Markets Live Executive Editor Mark Cudmore there. Right, one thing we've been watching today, the Japan 40-year bond auction. That's just happened. Let's take a look at how it went. We've got the bid cover ratio coming in at 2.54, which is bang on the 12-month average, also 2.54. So 399.8 billion yen of those 2065 bonds sold at a yield of 3.6%. That bid cover ratio coming in, as I mentioned, in line with the 12-month average. So it appears that the auction has gone off successfully. Well, let's get a little bit more on markets now with Carol Lai, Portfolio Manager and Senior Research Analyst at Brandywine Global. Carol, thanks so much for joining us. And I just want to pick up on that theme of somewhat conflicting and confusing messages coming from both the US and Iran in an uncertain environment such as this. Where do you see yields heading?
Right. I mean, to start off with, if you have Brent crude that's near like 120, which is what we saw yesterday, it definitely pushes up like the outlook for inflation and fiscal deficits. Global inflation is estimated to, rise by like 2 to 3 percentage points. Asia and Europe seeing the greatest increase. But we do have governments that are trying to temper the inflation via energy subsidies, which again, results in expansionary fiscal policy. So central banks really are being pushed to, do rate hikes. The market definitely is pricing 2 to 3 rate hikes. If you're talking about yields, where do we see where yields are heading to? Currently, where yields are, I think it's roughly pricing in a sustained oil price of about $85 per barrel until to the end of the year, so maybe about a year out on that. So where yields are, I think that's where that's where it's really pricing the $85 that we are, a sustained increase. The problem here is that if the war goes on for longer beyond April, and we get a further spike in oil towards $100 on a sustained basis over the next 1 year, that's where we can see yields really going up. But I think we also have to make a distinction between developed markets and emerging market yields, because at some some point, there will be greater global growth destruction from the supply shock, right? If we get a sustained $100 per barrel kind of scenario. And in that case, then perhaps the DM yields will start to come down, especially on the 10-year levels. So it may very much still play in that range of 375 all the way to 450, which is what the range was. For the U.S. Treasuries.
Well, let's roll with this scenario a little bit more, because there are a number of forecasts there which are more pessimistic than the one you've just painted. I mean, Goldman Sachs potentially sees oil above $100 heading into 2027. Just a few minutes ago, we were speaking to Muyu of Kpler, who sees a potential for $140 oil. So, if we consider those sorts of scenarios, what's your outlook then?
Right. In that case, I mean, like I said, we could get continued initial spike up in Treasury yields, global bond yields, and just speaking from, U.S. 10-year Treasuries as, a barometer, it could hit that 4.5% levels, a bit higher. But, at the end of the day, it still comes down to, are we getting global growth destruction, which I think the rest of the world, the markets have not fully priced that in. I think we started to see that on Friday last week when we saw growth-sensitive currencies, metals, precious metals, anything, risk assets correlation was just going to 1. And that was when we started to see that kind of destruction that is going to flow through into global growth. So if we are going to get a deeper slowdown in global growth, and I think today's PMI numbers that came out, I think we see in Australia, in Japan, we are already starting to see sentiment slowing down, then perhaps you hit 450, the top end of the range of Treasury yields, but then you may also get a back down in yields eventually. Yield curves may actually flatten instead of steepen going forward, just because there's going to be a slowdown in global growth, which is not fully priced in.
Do you think about stagflation very much? How real is that risk for you?
I mean, that risk is actually increasing by the week. And the longer the war goes on, the longer it affects not just oil prices, but petroleum derivatives. I mean, you have Takeichi today, Prime Minister Takeichi today, calling for a look through in terms of the supply chain in plastics, in petroleum. You have Australia saying that, they are reducing wheat planting because there's a lack of fertilizers. So with the war lengthening into April, there is going to be, an increased possibility and probability of a stagflationary environment, which we all have to kind of get prepared about. Which internally we have been preparing ourselves for a longer war than expected.
Yeah, if the conflict does continue to drag on, how much more upside do you see for the US dollar? And then, of course, once the conflict ends, what sort of reversal might we see?
Yeah, I think, and that's a very good question, because I think a lot of us came into this year, right, with the theme of, the dollar is going to continue weakening. It is a medium-term theme, and we think that still holds true. But the energy shock, obviously, now is really affecting the non-US countries very disproportionately, because it is impacting growth. Now, so therefore, the rest of the world currencies have really been weakening in response to the war. If you look at, the DXY, it has been, 99 to 100. We could possibly go even, towards 102, 103. But once the war ends and there is some kind of resolution, we believe that the medium-term thesis of a weaker, US dollar still remains intact. Why so? Because the fundamentals of a deteriorating U.S. fiscal position, don't forget they had to fund the war, and they're actually asking Congress for more money, so that deteriorates their fiscal position. There should be a reallocation out of U.S. assets again, and de-dollarization at the margins also still remain. So I think similar to if you look back in 2022 during the Russia-Ukraine war, there was the scenario where eventually the dollar actually faced depreciating pressures once the war settled down, and we are likely to see that again.
In terms of some of the calls, things you like, I mean, I know you like emerging markets, local currency bonds. Can you tell us about which markets you're favouring at the moment and why?
Yeah, so we still remain comfortable with selected EM local currency bonds that offer high real yields while offering also a high nominal carry cushion that really helps in this kind of scenarios. Countries like Brazil, Colombia are also less affected by the whole higher energy-driven inflation given they are energy exporters. So we are not surprised though that investors, who are positively positioned for EMs earlier in the year, their positioning is getting cleared out as risks have risen. But we are also remaining, positive on selected EMs. There's really pricing in this energy shock that are still fundamentally sound, so like Brazil, Colombia. But we are also looking out for more opportunities out there where energy prices are being priced in, for example, maybe in South Africa, Hungary to some extent as well. So some of these bonds are really getting sold off to some extent that's pricing in the energy shock.
You mentioned earlier some of the challenges for central bankers in this kind of environment. Well, we do have another Bank of Japan meeting coming up next month. Do you feel like this current geopolitical situation accelerates or does it delay rate normalization in Japan?
I think for Japan, in the recent last week's BOJ meeting, they did sound out the two-sided risk of higher inflation but lower growth. And with higher oil prices, the burden actually falls on fiscal policy because energy subsidies are there to temper inflation. But the BOJ will continue to be cautious on both the inflation and growth risk, right? They don't want to be in a hurry to raise rates quickly if global growth eventually slows quickly from here. So I think they're caught a little bit in a bind. Typically, the BOJ is always quite a bit more cautious. So I don't think it really quickens their pace as quickly, as what the market thinks. They are going to be a bit more aware and cognizant of the lower growth path that could actually happen if oil price shocks remain for extended period of time.
All right, Carol Lai of Brandywine Global, thank you so much for joining us today. Well, let's talk about Apollo curbing redemptions from one of its largest non-traded private credit funds for retail investors at 5%. This is after requests hit 11%. Now, it's the latest alternative asset manager to find itself grappling with a surge in withdrawal requests. Let's get to our Bloomberg Asia credit editor, Finbar Flynn. So, Finbar, did we learn anything new in this release?
Good afternoon, Paul. Yes, it was an interesting release. I think one of the notable points was if you were one of the 5% who is going to get some of your money back from the fund, they said that those people will only get about 45% on average of those funds back. So that may be a surprise to some of the investors. Elsewhere in the report, I think some of the fundamental numbers looked good. They said, for example, that the companies in the portfolios were revenue and EBITDA was increasing by about 8 to 11% respectively. But I suppose I'd also point out that they said loan to value was about 41%, and these are high yield or lower yielding companies. So we have to be aware that these companies are vulnerable to shocks, and like the shock you just mentioned, for example, with oil and slowing growth.
So are we seeing any signs that some of the concerns around private credit might be settling down at all?
I think we're probably a good way away from that, and we'll probably just see these concerns increase because we're going to have more of these kinds of releases coming out. I think we also have to bear in mind that these redemptions are actually a lagging indicator. These happened, the gates to actually the deadlines for these requests were a few months ago. So the environment has only got worse since. More people are seeing these headlines, more investors are getting worried. So we're likely to see elevated redemptions for a while. But I will say that, interestingly, Apollo said for its fund, it's got about 5.3 billion of ready available liquidity to handle those redemptions.
So what are the main risks that investors are looking out for at the moment?
I think, there are multiple risks. One, the biggest risk, I believe, is the software sector. This is a huge bet made by private credit. It's maybe 20% to 30% of all of private credit in the United States. And as we know, AI is putting an awful lot of pressure on these companies. These were meant to be, sticky revenues, little capex. So they were meant to be really, ideal borrowers, but that's all coming unwound in a sense. So there's an awful lot of uncertainty there. The other thing, of course, is the interconnectedness of private credit into the financial sector. These private credit and private equity owners, they also own the companies themselves. They own the insurers that are putting money into the funds. So if private credit was hit by anything like a recession in anytime soon, I think that is really the huge risk out there.
All right, Bloomberg Asia credit editor Finbar Flynn there. Still to come, with the planned summit between President Trump and China's Xi Jinping yet to be rescheduled, we'll discuss the prospect for further stabilization between the world's two largest economies. This is Bloomberg. Welcome back. You're watching Inside. The Eurasia Group says the planned summit between President Trump and China's Xi Jinping will further enhance stabilization of the relationship. The summit is yet to be rescheduled after Trump postponed it as he deals with the war in Iran. Eurasia's China practice head David Meale spoke to us in Beijing about the possible outcomes.
The world needs the commitment to the summit, and that commitment remains. What everybody is looking for, what President Trump and President Xi have made a political commitment to with each other, is to stabilize this relationship over a period of time. I think the Korea deal was a very positive deal. I think the fact that the U.S. is hosting G20 and China is hosting APEC, which means their ministers are running around in each other's big cities all year long, and the two leaders will meet in these multilateral environments, is also very positive. So sooner or later, I believe Trump will come here. I believe Xi will reciprocate and go to the U.S. And all of this sends signals throughout the bureaucracies on each side that will lead them to work together better than they would have otherwise.
You've heard all the speculation that the PLA is watching this very closely, a decapitation strike in Venezuela, a decapitation strike in Tehran. Do you buy into that kind of speculation that they're looking at avenues to employ China, that is, towards Taiwan?
I'm sure that there's a lot of watching going on. I'm a former diplomat, and this is, governments do this, and they are probably learning their lessons, assessing capabilities, and of course, China is, very focused on Taiwan. It is obviously preparing for any kinds of contingencies it might face. Whether this really changes their approach, I would say very unlikely.
Does a diversion of resources, military hardware, and attention by Washington to the Middle East, does that open the door for something to happen here for China and Taiwan?
I would say absolutely not. I believe that China has a policy towards Taiwan that is very deliberate. They will do things on their terms, when and how they want to. They're not going to be opportunistic about it. It is too risky. The other thing is, I don't believe China is looking for an opportunity to intervene militarily to deal with the Taiwan crisis. I think for now, they are still trying to work with non-military means, and for some years to come, it will probably look that way.
Up next, we speak to a naval warfare expert about the implications for security of prolonged disruption of the Strait of Hormuz, and more market analysis with BN. Welcome back. You're watching Inside. So let's take a look at how markets are tracking. It's been a really interesting day. We were up, then we were down, then we're back up again. And I'm just talking about the Kospi there. It turned negative for a while there. Now it's up by 2.25%, really becoming something of the risk barometer for this entire conflict in the Middle East. Elsewhere around the region, we are seeing a somewhat stronger Japanese yen, although I use that word relatively speaking. 158.74. It's stronger than it was yesterday, at least. Can't really really say the same for the Indian rupee. Hit a record low yesterday, still very weak as well, 93.74 at the moment. Elsewhere, we've got the Nikkei also better by 1%. One stock-specific story we're watching in Japan is Nintendo, now weaker by 4%. And this is after announcing that it's cutting back the production of the Switch 2, with demand for that console trailing the company's expectations. All of this being driven mostly by an oil price, however, which is a little bit softer today, 103.94 for a barrel of Brent. But I guess the message here is don't get used to it.
So in the absence of the Iran war, we think that a reasonable price for Brent would have been sort of in the 60s, and now we forecast Brent by year-end of 80. We think that a lot of the price increases we have seen reflect a risk premium as the market tries to hedge against the risk scenario, not necessarily the market's base case, but against the risk scenario of a long disruption.
So we actually see prices got a potential to hit as high as $140 per barrel in 3 to 4 weeks' time. So that's basically a $10 per barrel rise each week if there is no meaningful de-escalation in the conflict.
Meanwhile, ship tracking data shows 2 Indian-flagged vessels making their way through the Strait of Hormuz, carrying tens of thousands of tons of LPG. The ships are following the Iranian coastline, a precaution also taken by other vessels that have been approved by Tehran. Let's get more now with Bloomberg's Dan Murtagh. So, Dan, what is the latest on the traffic flowing through the Strait of Hormuz?
Well, there isn't much traffic flowing through the Strait of Hormuz as the latest. Most ships, the vast majority, hundreds of ships, are still backed up in the Persian Gulf or waiting outside. Just, they're too afraid. Their insurance won't let them pass through. But we have seen these small pockets, these 2 Indian LPG tankers that you mentioned, a few Chinese ships. Iran is able to move its crude through the Strait, seemingly almost at the same level it was before the war broke out. So what it tells us is that it's indicating that, if you can get in contact with Tehran and negotiate some sort of safe passage, you can get ships out, as you said, by hugging the coastline of Iran, going up through some Iranian islands, which I guess would give them a chance to inspect you and make sure you're the right ship that you say you are. And for India, this is a huge deal because India relies on LPG for cooking gas at hundreds of millions of homes throughout the country, and they get more than 60% of the fuel in imports, most of that from the Middle East. So getting a couple of cargoes is a real big relief for Modi and his government.
So what are the stakes in the Strait at the moment, and what is the latest strategy to securely transit cargo that would normally be traveling through there?
Yeah, there's a couple of different strategies at play. So Saudi Arabia is sending some crude from the Persian Gulf across the country in a pipeline out to the Red Sea, to Yanbu, where it's loading ships out there for Asia mostly. And then you have the UAE, which is moving crude oil by pipeline from inside the Persian Gulf to outside at Fujairah. But the vast majority of energy is still locked in, blocked off by the Strait of Hormuz. And so if you don't have, that assurance from the Iranian government that they won't attack you, these ship captains, they don't want to play with their sailors' lives. They don't want to, risk being attacked as they go through. And so everyone else is just playing a waiting game. And as long as that waiting game is happening, the bulk of these global energy flows are being bottled up, and that's what's keeping oil prices up above $100.
So what are some of the other factors that are impacting oil markets?
Yeah, right now, the big thing to watch is demand destruction, and you're seeing that. Oil prices are at 100, but a lot of fuel prices are much higher. Jet fuel is at $200 a barrel in some markets. Diesel and gasoline prices are spiking because it's not just oil that's blocked off; it's refined products as well. And so you're seeing in Pakistan, for example, they've asked fans of the Pakistan Super League cricket to stay home to conserve gasoline. You saw Vietnam announce that they were going to start canceling some flights today because they don't. The jet fuel is too expensive, and so that's the other way the market can balance this out. If you can't get supply, you have to start killing demand, and so we're starting to see that throughout the region.
All right, Bloomberg oil and gas reporter Dan Murtaugh there. Well, Pakistan is reportedly trying to take up the role of lead mediator in the war in Iran. According to the Financial Times, Islamabad is leveraging its ties to Washington and Tehran as it tries to broker an end to the conflict. Let's get more now from our Pakistan bureau chief, Fasih Mangi. So, Fasih, what would Pakistan bring to the table here?
Hey, Paul, thanks for having me. So what we understand is that, what Pakistan brings to the table is that it is someone that has very close ties with the Gulf countries. It's gotten a growingly closer relationship with Trump, and it is someone that understands the region quite well. So Iran being its neighbor, Pakistan has had long ties with it, and historically we've seen last year as well when there was a clash that happened between the U.S. and Iran last year, Pakistan did do some back channeling then too, and it seems that Pakistan is now making a push to mediate talks between the two countries, the US and Iran, and Pakistan is positioning Islamabad as a destination for the talks. This is what we are getting from our sources as well.
So how has Pakistan's relationship with the United States evolved in the recent months?
So what we've seen is that Pakistan's relationship with the US has not been closer than what it is today in decades. It's the best relationship that it's been there in decades. It all started last year when Pakistan had a conflict with India. Since then, Pakistan has said that Trump was an integral part in brokering the ceasefire between the two countries. Since then, we've seen that Pakistan has had growing relationships with the U.S. when it comes to trade, when it comes to investments, when it comes to even crypto forays that Pakistan is making right now. So all in all, we've seen that ties have grown closer than ever before.
That was Pakistan Bureau Chief Fasih Mangi there. Joining us now is Jennifer Parker, Adjunct Professor at the University of Western Australia's Defence and Security Institute. Jennifer, thanks so much for joining us today. And I'm wondering if we can start by discussing the current state of the security situation in the Middle East, particularly this claim that President Trump has negotiations underway, Iran denying it, and then at the same time we've got thousands of US Marines due to arrive in the region on Friday. What does that imminent arrival suggest to you?
Well, look, I don't think we can make an assumption that this conflict is about to be over anytime soon. But I think with President Trump's comments on talks and Iran's denial, I think it is very clear that some degree of talks are going on. Now, we've seen the Egyptian Foreign Ministry tweet and then confirm that there was a meeting over the weekend between the US envoy Steve Witkoff and the Iranian Foreign Ministry and some others. We've also seen Pakistan talk about them speaking to Iran and hoping to be a mediator. So some degree of talks are clearly going on. And in the end, this was always where this conflict was going to end. I think the US outlines their 4 key military objectives. But to get to the end of that, they were going to have some degree of diplomacy. I think it will be important for the US to be able to demonstrate, though, that they have limited and set back Iran's military capability. But in terms of when this conflict ends, look, I think you'd be a fool to try and predict that. But I do think we are talking, hopefully, in the magnitude of weeks, not months.
Now, in the fog of war, we're often left resorting to speculation, so I'm wondering what your view is on why Iran would deny negotiations are taking place.
Look, I think there's a couple of elements. It's been clear during this conflict that Iran's information operations campaign has been to attack and discredit President Trump. So they've made a lot of comments. In fact, there was a tweet over the weekend from an Iranian official talking about, President Trump, you're fired, referring to his previous television show before he entered politics. So given that President Trump had said very clearly that he was not going to go ahead with strikes on power stations, which, to be honest, was highly unlikely. Strikes on power stations are most likely a breach of international humanitarian law. So I don't think the US was about to do that. But given that he had said that and then backed away from that, I think it's part of Iran's information operations campaign to try and make him look weak or inconsistent. That said, there's also potentially another explanation, which is that the Iranian Revolutionary Guard and the Iranian Revolutionary regime more broadly don't have great internal communications. We know from some US intelligence reporting within US Congress that the regime is intact, but it's certainly significantly degraded. So whether they are communicating effectively, unclear. You may also be seeing different tussles within the regime for power. Now, of course, they've appointed their new supreme leader. He does not come with the clout of the previous supreme leader. And there are genuine questions about whether he is well or even alive. So all of those things may have fed into Iran's denial.
Now, who would you consider would have the upper hand in this conflict heading into the negotiating table, bearing in mind all Iran's regime really needs to do is keep the oil price high and stay in place?
Well, I mean, that assumes that President Trump is going to respond to global economic pressure. There was some reporting in the initial week of this campaign that the US were surprised that Iran had started attacking ships in the Strait of Hormuz. I spent a lot of time deployed to the Middle East with the US. There would be no surprise that Iran has started attacking ships. In fact, this is what Iran does. Its geographical advantage is the fact that it is the dominant player across the northern Arabian Gulf, the Strait of Hormuz and the Gulf of Oman. And what it does in response to crises is attack ships. This is not new. The scale of this is increased, but certainly we saw Iran attacking ships during the tanker wars, during the Gulf crisis in 2019, 2020, a number of times since then, and certainly supporting the Houthis' attacks on ships over the last 2 years. So I don't think that's a surprise to the US. Yes, of course, this is putting significant pressure on global oil supplies, on the global economy, which will put pressure on the US. But I think that they are keen to achieve their 4 military objectives. And to be honest, I think it is in the world's interest that Iran's military capabilities are set back. We saw last week reports of missiles being fired from Iran at Diego Garcia, which indicates Iran's ballistic missile capability is much more advanced than most people thought.
Yes, and I think it's worth mentioning for our viewers as well, and you alluded to it there, your operational experience, more than 20 years serving with the Australian Navy. So with that in mind, I would like your analysis of one of Iran's threats, and that is to mine the Strait of Hormuz. How credible, how possible is that, and how do you make the Strait safe again once hostilities end?
Look, it's certainly possible, and if this did happen, it would certainly delay any resumption of large numbers of shipping transiting the Straits, even after the conflict had ceased. Now, this has always been the threat from Iran, and in fact, during the tanker wars in the 80s, Iran did mine the Arabian Gulf. I think it is potentially unlikely that Iran will do this here, because the types of mines it employs, so mines that respond to the acoustic signatures of ships or the magnetic signatures of ships, don't discriminate between types of tankers. Iran is relying on its ability to continue to get tankers with oil from Cargo Island, which is inside the Arabian Gulf, outside of the Strait, and has continued to do so. And in fact, the US has allowed them to continue to do so. I thought the US might blockade these tankers in the Indian Ocean, but they haven't. If they were to mine the Straits, they would be undermining their own ability to get oil safely out. And their economy is almost entirely dependent on oil. So is it possible? Yes. There have been some reports of US officials, unnamed, saying it has happened, but I think that it is unlikely to happen on a large scale because of the impact on Iran.
Now, we've also heard today the possibility of Saudi Arabia and the United Arab Emirates joining this conflict in an escalation. I would be interested in your analysis of how significant you would see that escalation. What kind of role would those countries play?
Yeah, look, that would be significant. And we have seen late last week, we did see Saudi Arabia make a statement that after Iran had continued to attack oil infrastructure in Saudi Arabia, that they were going to pursue both political and non-political means, and non-political being a veil for potentially military attacks on Iran. If they did undertake attacks on Iran, of course, they are able to defend themselves under international law. This would see a significant expansion and escalation of this conflict. Now, would they do that? It's unclear, but if they did do this, I think you would see this further deterioration of relationships within the region. I think you would see pressure from other Gulf countries on Saudi Arabia and UAE not to do so. That said, Saudi Arabia has undertaken a number of strikes in Yemen in recent times and demonstrated that they are willing to accept risk when it comes to military strikes. If they did that, what shape or form would that be? That would be airstrikes against a range of targets within Iran. If they did that, I suspect that would be coordinated with US and Israeli forces in terms of the targets they are trying to hit in priority order.
Well, US allies haven't exactly been eager to get involved in this fight, particularly ones that aren't in the Middle East, but Australia has put in a contribution of some airborne early warning aircraft, air-to-air missiles as well. Do you view this as symbolic, or does it come with a strategic cost that could outweigh any benefit to Australian security?
Yeah, look, it's not symbolic, but I also don't think it comes with a strategic cost. There's been a lot made of the contribution of the airborne early warning aircraft, which is able to detect both maritime and air targets, so drones and missiles and ships for that matter, in terms of whether this makes Australia a party to this international armed conflict. My view would be under international law, Australia is not involved in strikes on Iran and therefore is not a belligerent or a party to this international armed conflict. But it is an important contribution. This is a very capable aircraft which will be assisting in terms of the air picture of defending those Gulf states. And Australia and the UAE have a long-standing partnership. So it's not a tokenistic contribution. In terms of the contribution and what is the strategic benefit, Iran is a regional and global threat. And sometimes in the discussion of this war, especially because the US have not made the case for the conflict beforehand, did not try and develop a coalition, what's been lost in this is the destabilising role Iran has played regionally and globally. Remember last year we saw the Director General of ASIO in Australia, Mike Burgess, talk about the attacks in Australia in 2024, anti-Semitic attacks that were sponsored by Iran that led to expelling Iran's ambassador. So I think setting back Iran's ballistic missile capability and setting back Iran's nuclear capability is in Australia's security interests. So I think that strategically this is in our interests.
All right, Jennifer Parker, Adjunct Professor at University of Western Australia Defence and Security Institute. Much appreciate your analysis today. Still to come on Insight, Hong Kong set to extend tax concessions for family offices as it positions itself as a financial safe haven amid geopolitical turmoil. More next from our conversation with Financial Services Secretary Christopher Hui. This is Bloomberg. Welcome back. You're watching Insight. The Hong Kong government says it plans to extend tax concessions given to family offices and funds to include more asset classes such as digital assets, precious metals and private credit. The city's Secretary for Financial Services and Treasury, Christopher Hui, told us more about the city's push to position itself as a financial safe haven.
Hong Kong as a financial center, we've been going all out in terms of reforming our capital market, at the same time try to draw international capital here. As you can see, like for example, last year we have 119 listings in Hong Kong, and also the proceeds that we get at IPO is a record number. And at the same time, what you see is apart from capital formation on the wealth management side, we are also seeing that increasingly more people are interested in family offices in Hong Kong. And that's why this week we have the Wealth for Good Summit here.
And what's the message this year?
As you said, I think we are in a very complex world, but that said, Hong Kong as a safe, stable, and also sophisticated financial center is always ready to serve the world. Like, for example, apart from having the conference here today, we also have a series of reforms and measures to draw global capital. In fact, we are going to put together a bill for legislative approval to extend the tax concession options that we give to family offices and funds to include more asset classes like digital asset, precious metal, and also private credit. And at the same time, we are also trying to enhance our role as a wealth management center by leveraging the overall need of corporates for internal cash management. So that's why we are going to revamp our law and also our regime to enhance our tax concession to given for these treasury centers in Hong Kong in such a way that for corporates, if they want to manage their cash internally through Hong Kong, we have a more favorable regime for them.
I need to ask the connection and what we're seeing in as far as the risks and opportunities because of what's happening in the Middle East. And we know, of course, we've talked about this a lot, that Hong Kong has built this Middle East corridor. In what ways do you think Hong Kong is prepared to receive some of the flows that could be getting out that part of the world?
Hong Kong is always ready, despite what's happening around us. If you look at the reforms that I said into wealth management, at the same time reforms that we have to our capital market by lowering the threshold for weighted voting right, and also at the same time to expand the definition of technology companies to be listed here. We are always on the drive in terms of making our market more competitive. That's number one. And number two, if you look at the recent number, right now, for example, through our Invest Hong Kong, we have around 156 family offices who have already indicated their plan to set up or expand in Hong Kong. And also this time, when we have the Wealth Focus Summit for the fourth time, we're also welcoming more guests from the Middle East. Actually, there's a one from the Morocco family offices that already indicated and also confirmed their interest to expand here. So I think all these are actually showcasing our role as a financial center and also being a safe, stable, and also sophisticated one in this complex world.
I see. And this group from the Middle East, they're still scheduled to come?
Yes. Yeah.
Okay. Yeah. I understand. Have we seen any early signs that a transfer of some wealth because of what's happening there to Hong Kong? What early conversations are you having?
If you recall, the chief executive led a delegation to the Middle East some time ago. And at the same time, as a follow-up, my bureau and also Invest Hong Kong has been closely monitoring the developments throughout with a view to identifying needs of these companies, corporates, and also individuals to see how Hong Kong can serve them better. And again, that's context. That's why we have increasing interest from the Eastern family offices to come. And it's also being seen from the turnout from this year's Wealth Focus Summit.
That's Hong Kong Secretary for Financial Services and the Treasury, Christopher Hui, speaking to Bloomberg, the China show co-anchor David Ingles. Still to come, we check where investors are moving their money in the face of elevated global risk. BMY FX and macro strategist John Velis is going to share his insights next. Stay with us for that conversation. This is Bloomberg. Welcome back. You're watching Insight. The spectre of stagflation caused by the Iran war has wiped more than $2.5 trillion from the value of global bonds in March, putting them on track for the biggest monthly loss in more than 3 years. For more on this, let's get to Ruth Carson, our chief correspondent for FX and rates in Asia. So, Ruth, are we just getting started?
I think that's a great question. And how long is a piece of string? A lot of what we're seeing, not just in bonds, but, asset classes like stocks, gold, silver, take your pick. A lot of it is tied to what is happening in the Middle East right now and elevated energy prices. Higher oil means higher inflation, and that impacts everything. Japan bonds through to treasuries, through to Australian government bonds. Basically, nothing is safe here. And that's why we're seeing a lot of selling and that much pressure in bonds, traditionally some of the safest assets in the world. Not so now.
So at what point could bonds like treasuries become a haven, or is this something that's a lot further off in the future? And do you see losses have got a bit further to run yet?
It is the million-dollar question, and it is a question that is asked every single day when I speak with money managers and, your hedge funds, your traders. Everyone is sort of grappling with the idea of, look, at these levels, in theory, the risk-free rate, say benchmark 10s at, 4.2, 4.4, these are fantastic levels to buy. But the question is, do you actually dare to do so when the war is raging in the Middle East right now, when there is, it's headline to headline trading, and that's almost impossible to do. Do you actually buy bonds today and then have to reposition tomorrow because, your stop losses are triggered? So when will treasuries become a haven? Well, probably when growth fears of a global economic shock really start to creep into the narrative of markets. And right now, it's still inflation fears.
So treasuries aren't a haven. We're not talking about gold or the yen as a haven either. So that really only leaves one thing, right?
Yes, and there's a reason why the dollar is called King Dollar. It is the reserve currency of the world. It's on about 90% of all trades when it comes to foreign exchange every single day in a $9.5 trillion a day market. There is a reason why when things go downhill, everyone flocks to the dollar. And at this point in time, there's definitely nothing that rivals it when it comes to haven attributes.
All right, Bloomberg's chief correspondent for FX and rates in Asia, Ruth Carson. Well, our next guest has an out-of-consensus call for 2 Fed rate cuts this year. Let's get to John Velis, FX and macro strategist Americas at BNY. So, John, tell us a little bit more about that call. Are you an optimist in the room?
No, good afternoon. No, I'm more of a realist, and coming into the year, I actually had 3 Fed rate cuts in the forecast, basically because I thought the labor market was quite moribund and vulnerable to shocks. And well, lo and behold, we got quite a shock in the last 3-4 weeks. And what that's done is obviously it's raised inflation expectations, it's put the Fed on a hold path, other G10 central banks towards a hiking bias. So you may wonder, why do you still see cuts ahead? And the reason is very low conviction on the probabilities. We're not really great at geopolitical analysis, even the specialists are these days, is if the war winds down, whether it was last night with the Truth Social post or it's some weeks or months ahead, but sometime by the Northern Hemisphere summer, if that's the case, then I think you'll see inflation expectations and oil prices start to go in the right direction, lower, not necessarily achieving where they were before the war, of course. There's still a risk premium to be priced into some of these inputs and risk assets. Then the labor market will become top concern, and the Fed will say, look, we have room to cut because inflation expectations have peaked, they're coming down, the uncertainty of the war is being relieved and somewhat mitigated. So job number one is the labor market, as long as inflation is going in the right direction, even if it hasn't reached quite the right level. I recognize that's highly scenario dependent, and the last 3 weeks have taught us counting on scenarios is a very difficult game to play. So this is I would say a binary call, where if the war ends, as I say, around mid-year and things move in the right direction without actually getting to where we want them to be, but directionally correct, that's the 2-cut recipe. The no-cut or even the hike recipe is, of course, a prolonged conflict with significant damage across infrastructure and commodity and energy prices.
Yeah, a menu of scenarios is pretty much what we've got at the moment. I'd be interested in your scenario for the US dollar, though, because Ruth was just talking there about how it's become the only haven at the moment. So if you're correct, if we do see a reasonably rapid end to the war and we get a couple of rate cuts as well, could we see a pretty active repricing of the US dollar?
I think that's possible. I think the other thing that could undermine more the long-term structural case for dollar dominance, which I was never a big believer in, but if Iran is succeeding in collecting RMB for passage through the Straits, that essentially doesn't spell the death of the petrodollar, but it certainly weakens it. And that was one of the pillars of dollar dominance since the 1960s, since Bretton Woods, at least in the early 70s. So I think there's a structural force that could emerge as dollar negative, but more importantly, short-term, like you say, the dollar is the haven. The other place that we're seeing, you said gold is off, equities are off, spreads are wider, other currencies are off, is cash. And we've seen, we sit on the world's largest database of real money institutional client flows. And we saw really since the beginning of February, kind of in the lead up to the war, when the belligerence and the commentary and the rhetoric started, people coming out of risk assets across the world and going into short-term G10 safe paper. And that's accelerated since hostilities have broken out. So that's the other place. And of course, there's a dollar component to that as well, because they're all anchored on Fed rates.
So you mentioned that you do have that out of consensus call for a couple of cuts there, perhaps the labour market, as you say, becoming a concern for the Fed later in the year. Well, Stephen Myron's looking for 4 cuts this year. I'm starting to get the feeling people have forgotten that inflation's a thing.
I agree with that, and that's one of the dilemmas. Now, to quote the chair, he said, quote, we're in a difficult position, right? Both goals are at risk right now. The question is, in the scenario that I paint, which is optimistic and not necessarily guaranteed to happen, a mid-year cessation of, the crisis, then I think 2 rate cuts are appropriate for the labor market. I think the Fed will be somewhat acquiescent on higher than target inflation in that case, and they'll lean towards it, arguing the tariffs are still passing through, they'll eventually wash out, the oil price shock is eventually going to wash out, and inflation expectations are coming in the right direction, if not where we want them to be in level terms, so we can go ahead and cut because of the labor market while keeping an eye on inflation. That's why, the risk to that is you get curve steepening, because it looks like the Fed is, as you said, kind of forgetting about inflation. I don't think that's the case, but that could be the appearance that's given, and that could keep inflation expectations well bid.
The phrase "we don't know" is one that we heard a lot from Jay Powell last week when the Fed handed down its decision. He's talking about the outlook there. Can we even say what the terminal rate is right now?
No, we don't know. He said it 3 times, as you mentioned, in the press conference. And just as a sort of anecdote, earlier that morning in the U.S., the Bank of Canada moved, or didn't move, but had a rate-setting meeting, and the statement said uncertainty is, quote, acute, which is a more clinical way of saying we just don't know. So that's where central banks are, particularly ones that don't face an inflation monster like in heavily energy import-dependent economies. So the question is, can we really make a rate path currently? No, we can't, because all these scenarios, I have a view, but it's based on a sketchy probability of a scenario that I think could happen and allow the 2 rate cuts. I could make a case for no rate cuts or even a hike very easily, and that's why I would kind of echo the chair in that we just don't know, and we are in a difficult spot with our 2 goals at risk and uncertainty extraordinarily acute.
Let's talk about some of the other sides of these currency pairs, particularly EM. The EM carry trade's heading for a pretty bad month, its worst in 4 years. Is it possible to predict what's coming next for the EM carry trade?
No, it's not. It's the same back to we just don't know, but that's not an adequate answer. So I'll give you the kind of things that I'd like to look for. Some weakening of the dollar, given either the interest rate differential that we've already discussed and or the cessation of hostilities, which allows risk to come back and gain some appetite, and therefore, undo some of those dollar long safe haven bets. That would, really, particularly if the energy shock has peaked and is coming down, some of these, particularly Asian EMs, will see attractive valuations. Central banks that don't necessarily need to hike rates, they can manage the fuel prices via tax refunds or tax cuts, and demand destruction will lower inflation expectations in these countries. So you could see a case to be made on the cessation of hostilities, again, scenario dependent, that EM could rally once the dollar starts to come off with a return to risk appetite.
I'm wondering if we can get your views on one emerging market currency that we follow very closely on the show, and that is the rupee, which just keeps on setting record lows. When do you think we're going to see a floor for that currency?
I think it's the same story as the rest of the EM countries that we reserved. India is a big oil importer, energy importer. Of course, they do have relations with Iran that allow them perhaps to get energy more easily than other places. I would prefer not to make a level call for the rupee, but I think India is a case writ large of this larger problem that we discussed earlier.
Also earlier, you did mention that Iran's looking at pricing some cargoes for crude in RMB. I mean, you said that this is no threat to the dollar, but how do these things get started, and where could we possibly end up if that becomes a trend?
Oh, I think it's a looming threat to the dollar. I don't think it's an immediate threat to the dollar, but if the world moves in that direction, and there were analysts after the Ukraine war started that said, the commodity trade will start to be priced in non-dollar currencies because the commodity trade is essentially a non-U.S. involved trade. And if you extend that to oil and RMB in the end of, and the whittling away or even lessening the petrodollar strength pillar, then I think you have a dollar, I wouldn't say at the end of dollar dominance or anything like that. I'm still a believer in dollar dominance, but it is one level of support of king dollar that's taken away. It could weaken it structurally, not necessarily cyclically.
Are you seeing any signs of fatigue from a market that pretty much daily has to respond from social media posts from President Trump that may or may not be an accurate reflection of what's really going on?
Yes, the short answer is yes. I've talked before the war, since the beginning of the year. I've spoken to maybe 50 clients and here in the region, and some other trips I've made recently. I've spoken to another 24 or so. And conviction before the conflict was very low. There was not a lot of value to be seen in most traditional asset classes. There were risks in things like private asset classes, so there was low conviction anyway. Now, interestingly, you know, I was talking to someone who made a list of concerns before the war, and their three concerns before they got to Iran, U.S., Israel was AI valuation, the AI build generally, private credit, somewhat related, and extended valuations across most risk asset classes. The war was fourth. Well, the wars leaped to top on the list, but the other three elements are still there. So I don't really know where the conviction's going to come from. And as you say, trying to follow no fundamentals, no technical analysis or anything like that, but news flow, to put it as in a sophisticated term, is a difficult game to play. There was a cartoon I saw recently circulating. They had a trader in front of his 4 screens looking at fundamentals and graphs and charts. It said that was before, this is now, and it was a guy looking at a screen of Twitter. And it was the same trader. So that's the world we're living in, and that's what I think our clients and the people I speak to on the street feel the same way, which means a lot of, what does that lead you to do? Cash in the dollar.
And that's a good way to wrap this conversation up, because, you know, uncertainty has been a theme of not just this conversation, but markets broadly at the moment, as we've been discussing. So with that in mind, what is your conviction? Where do you put money? Do you just park it?
I wouldn't put new money to work. I'd park it. There will be, you know, if things deteriorate further, there could be interesting, particularly if and when the conflict's wrapped up and things are at low levels, there's some value and some bargains to be hunted. But I think this is a classic risk-off scenario with a lot of, as we've mentioned many times already, a lot of uncertainty around it. It's going to make it difficult to deploy new capital in other places because we simply, say it again, we just don't know.
All right. John Velis of BNY, thanks so much for joining us today. Well, as we've been discussing, Nintendo shares fell. This is as Bloomberg reported. The company is cutting back production of the Switch 2. Sources say demand for the $450 gaming console is trailing the company's expectations, particularly in the US. Our tech reporter Takashi Mochizuki broke the story. So, Takashi, Nintendo had a blockbuster launch. What happened?
Okay, so because Nintendo Switch 2 had a blockbuster debut, Nintendo management believed that moment would continue into the holiday season, but the actual sales fell short of expectations, and that's due to people who usually wait until holiday season to buy a console purchased in summer instead, because they feared the Nintendo Switch 2's price would raise because of the tariff, and something that Nintendo president signaled it as a possibility.
So is this an industry-wide demand issue, or is it something that's specific to Nintendo?
It's both. Of course, in the inflation and the macroeconomic condition is affecting the whole entertainment industry, including the video games. But particularly for Nintendo, during the holiday season, they didn't have any blockbuster titles that Nintendo was hoping to persuade people to buy a new console. They did have a title called Metroid Prime 4, which is a popular franchise in the US, and Nintendo believed that would be strong enough to persuade people in the US to buy the console, but the game fell short of expectations and disappointing, and that is partly why the holiday season hardware sales in the US was weak.
So does this change the long-term story?
Not fundamentally yet, because Nintendo hasn't released, any titles from the top-tier franchises, including Zelda. Of course, Nintendo can always upgrade their console to revive the momentum. But the worrisome signals included war in the Middle East, because if that lasts longer, that will of course affect the production and the shipping, which will jeopardize Nintendo's planning to when and where to ship and make consoles. And also another bigger worrisome sign in the longer term is the software sales. Compared to the Switch 1, the people are not buying many games on the Switch 2, and of course Nintendo makes money on the Switch. Nintendo makes money on the software side. Nintendo hasn't been able to sell many games. Is kind of worrying, and that's what investors are paying attention to right now.
All right, Bloomberg tech reporter Takashi Mochizuki, thank you so much for joining us. Still to come, Australia and the European Union agree to a sweeping free trade deal after years of negotiations. A closer look at what's on the table up next. This is Bloomberg.
Today, we are telling an important story to a world that is deeply changing. A world where great powers are using tariffs as a leverage and supply chains as vulnerabilities to be exploited. In our story, open, rules-based trade delivers positive sum outcomes. Trust matters more than transactions.
We're pleased to announce the signing of a new Australia-EU security and defence partnership. The partnership provides a framework to strengthen cooperation between Australia and our European friends so that we can best respond to pressing global challenges. It will bolster our collaboration on defence industry, maritime security, cyber security, countering terrorism and combating hybrid threats such as disinformation. And it shows our shared commitment to global peace and security, including reaffirming our steadfast support for Ukraine in the face of Russia's illegal full-scale invasion.
That's Australian Prime Minister Anthony Albanese and European Commission President Ursula von der Leyen speaking in Canberra after announcing a free trade deal and signing a security pact. Let's get more from our Australia government reporter James Mager. So, James, can you talk to us a little bit about the significance of this FTA, the process of getting here, and what it's going to be worth?
This FTA is pretty significant. If you're an Australian farmer and you're trying to sell beef overseas, if you're a European Prosecco manufacturer and you want to sell more Prosecco in Australia, there is going to be benefits especially for those agricultural industries, those farm products, dairy, lamb, these kinds of things. And both sides were trying to make, the Europeans and the Australians were making the case that there is going to be benefits for their domestic industries. But I think those two clips that you just played there from Ursula von der Leyen and then from Anthony Albanese, speaking about the other things that aren't economics, that aren't trade, as I think that really shows how we got here. When this deal collapsed in 2023 and the Australians walked away, the reason they walked away was they weren't going to get tens of thousands more tons of beef exports to Europe, and in the end they didn't get tens of thousands more beef. They got a 30,000 ton new tariff rate quota. That wasn't good enough in 2023. It was good enough today. And the reason for that is really what Albanese and von der Leyen are talking about there. It's the security challenges have got a lot worse since 2023. China's using, or as she spoke about that, she said China's weaponizing its supply chains and supply chain dependencies to damage economies in Europe and to damage the US economy. And those things have become much more important. And so more than the FTA today, which is going to probably lead to billions of dollars more in trade, more than the FTA, it's that critical minerals deal that was also signed today. It's that security partnership that was also signed today. Those are the things that really sort of drove this package deal that was announced, and those are the things that I think both sides are really pointing to as the big steps forward from today.
Yeah, let's talk a little bit about the defence agreements in particular. What's in the deal, what's covered by that agreement, and what do the leaders have to say about the current security environment?
So obviously the European Union doesn't have its own military. So on any kind of military to military cooperation, whether it's joint defense or joint exercises or those kinds of things, or even sales of weapons, that's going to be between Australia and France, or Australia and Germany, or Australia and other European countries. But the European Union does have, they do have military programs. They have things called SAFE, which is a program that the European nations and the UK, for example, and Japan and other countries are using to sort of join that, and then they can start selling weaponry to European countries. Australia didn't join that yet, but there is those kind of sort of ancillary benefits on cooperation on weapons development, cyberspace defense, and these other kinds of things. And so there's opportunities for both sides to do more kind of cooperation on that. And obviously, the reason they spoke about that and the reason it's so important is because the Ukraine war is not going away. The Middle East is breaking out in conflict. There are high tensions in the Asia-Pacific region. And so both sides see their security environment getting worse, and they're looking for friends and partners.
All right, Bloomberg's Australia government and economy reporter James Mager there. Before we go, let's take a look at what's coming up tomorrow. We're going to be live from the Aviation Festival Asia event in Singapore, talking to top industry executives, including Philippine Airlines President Richard Nuttall. That's it for Insight, though. Horizons Middle East and Africa coming up next. This is Bloomberg.